So we have accounting standard related to effects of changes in foreign exchange rate. This accounting standard deals with the reporting of foreign exchange transactions and financial statements of an organization. So what you are doing here is you are reporting foreign exchange transactions, foreign exchange rates in your financial statements. Okay, balance sheet, P&L, cash flows, changes in equity, they are your financial statements. You are reporting in your financial statements. An enterprise may carry on activities involving foreign exchange in two ways. Firstly, it may have transactions in foreign currencies, and secondly, it may have foreign operations. So, your enterprise may carry on activities involving foreign exchange in two ways. Okay. First is the way in which you have your foreign currency transactions, and second, you have foreign operations. For this purpose, transactions must be expressed in the enterprise reporting currency and financial statements. For this purpose, what you are required to do? You are required to express in reporting currency. Yeah, nahi samjha. So what they are trying to tell you here is, suppose I am dealing with Japan. Okay. Yes, there in Japan they go for Japanese yen or say US dollars. So yeah, so maybe I'm dealing, my transactions are in dollars or Japanese yen, but while presenting to my directors, my board of directors, what I'm supposed to do is I'm supposed to present it in reporting currency, that is Indian currency. I need to convert US dollars to Indian rupee. Okay, so that conversion I need to study. Matlab, everything, the entire chapter is based on that conversion. The principal issues in accounting for foreign currency transactions and foreign operations are to decide which exchange rate to use and how to recognize in financial statements the financial effect of changes in exchange rate. So, which rate to use, what to do, how to convert, all these things we study here. Scope. Scope means what all things are covered here. AS11 deals with accounting for transactions in foreign currencies. Translating financial statements of foreign operations to reporting currency. Accounting for foreign currency transactions in nature of forward exchange contracts. So all these points are covered here. Accounting for transactions in foreign currencies, translating my financial statements. It is entire amount, all my invoice, my books of accounts is in foreign currency. I need to convert that foreign currency to local currency. Okay, so accounting for transactions in foreign currencies, translating financial statements of foreign operations to reporting currency, accounting for foreign currency transactions in nature of forward exchange contracts. The standard, however, does not cover the following issues. It does not specify currency in which an enterprise should present its financial statements. The standard, however, does not cover following issues. So what all are the issues? It does not specify the currency in which an enterprise should present its financial statements. Reporting currency, but what is the reporting currency? Restatement of an enterprise financial statement from its reporting currency into another currency. It will not specify. It is not telling you that you have to frame one more statement from reporting to Indian normal currency, another currency. No, standard is not asking you to do that. Presentation and cash flow statements of cash flow arising from transactions in foreign currency and translation of cash flows of foreign operations. Exchange difference arising from foreign currency borrowings to the extent they are regarded as adjustments to interest cost. So we have objective and scope. Then we have definitions. Following terms are used in this standard with the meaning specified. Average rate is the mean of exchange rates in force during a period. Closing rate is the exchange rate at the balance sheet date. Exchange difference is the difference resulting from reporting the same number of units of a foreign currency and reporting currency at different exchange rates. So we have here definitions. Definitions are very, very important. They can ask you, dash is the mean of exchange rate in force during a year, average rate. Closing rate is the exchange rate at the balance sheet date. So they have defined, and these definitions are very, very important for objectives. MCQs, true or false, match the column, fill in the blanks, very, very important. Yeah, you need to study this objectives. You cannot skip this definitions. Foreign currency transactions. A foreign currency transaction is a transaction which is denominated in or requires settlement in a foreign currency. So what is foreign currency transaction? Foreign currency transaction is nothing but is a transaction which is denominated in another currency or requires to be settled in foreign currency. So that is foreign currency transaction. When an enterprise buys or sells goods or services which is in another foreign currency, borrows or lends funds when the amount payable or receivable are denominated in foreign currency, becomes a party to an unperformed forward exchange contract, otherwise acquires or dispose of assets or settles liabilities denominated in foreign currency. So foreign currency transactions are explained here. Then we have initial recognition. A foreign currency transaction should be recorded on initial recognition in the reporting currency. By applying to the foreign currency amount the exchange rate between the reporting currency and the foreign currency. So initial recognition. First we studied what is foreign currency transactions, meaning denominated in other currency. I'm buying in US dollar, that means I went into foreign currency transaction. I'm buying into Japanese yen, that is foreign currency transaction. Okay. Initial recognition. Foreign currency transaction should be recorded on initial recognition and reporting currency by applying to foreign currency amount the exchange rate between reporting currency and foreign currency. So I want to recognize, I want to record in my book. So what I'll do is I'll write purchase of water bottle from US for $12. $12 into my exchange rate and the Indian rupee. So that I need to present that they are saying here. A quick read, I'll take a pause, then I'll go for reporting at subsequent balance sheet date. Next we have reporting at subsequent balance sheet date. Foreign currency monetary items, such items should be reported using closing rate. So you have to report now for example, today we went for a transaction. Okay, I have purchased from you on 18th March. Today I am purchasing it. Now I am required, I asked you that today I'll not make a payment. I'll make payment on 5th April. Okay, in between, in April you have, in between you have 31st March. So what you are required to do is 18th March you'll book a price, with exchange rate you'll book a price, say 1 lakh rupees. Then you have 31st March, on that date the exchange rate changed. So suppose you have booked at 1 lakh 5, and while making payment you are doing at 1 lakh 2,000. So this can happen. So that's what they are mentioning here. Your payment date is different, but in between you are getting a closing date. So that closing date needs to be taken care of. So foreign currency monetary items, such items should be reported using closing rate. However, in certain circumstances, the closing rate may not reflect with reasonable accuracy the amount in reporting currency that is likely to be realized from or required to disburse a foreign currency monetary item at the balance sheet date. Example, where there are restrictions or on remittance, or where the closing rate is unrealistic and it is not possible to affect an exchange of currencies at that rate at the balance sheet date. In such circumstances, the relevant monetary item should be reported in the reporting currency at the amount which is likely to be realized from or required to disburse such item at the balance sheet date. So that is foreign currency monetary items. So you need to record your closing date. On closing date you need to close your balance sheet. You need to record by multiplying whatever rate is available at that time. Okay, then you have foreign currency. Yes. Foreign currency non-monetary items at historical cost. Yes, yes, yes. 31st March, 31st March. 31st March will be the closing date. Then we have foreign currency non-monetary items at historical cost. Such items which are carried in terms of historical cost denominated in foreign currency should be reported using exchange rate at the date of the transaction. So foreign currency non-monetary items at historical cost. Foreign currency non-monetary items at historical cost. Such items which are carried in terms of historical cost denominated in a foreign currency should be reported using exchange rate at the date of transaction. Foreign currency non-monetary items at fair value. Such items which are exercised at fair value or other similar valuation denominated in a foreign currency should be reported using exchange rates that existed when the values are determined. So we have foreign currency monetary items, foreign currency non-monetary items at historical cost, and foreign currency non-monetary items at fair value. So we have monetary items, non-monetary items at historical cost. So you are recording your non-monetary items at past cost and you are recording your non-monetary items at fair value, market value. You please give me a watch instead of 10,000 rupees as my fees, you give me a watch of 10,000. So income tax will be like, okay, what is considered as your fees, will find out the fair value, that is market value of the fees, and accordingly what we'll do is we'll charge you for taxation. So that way, non-monetary items at fair value, non-monetary items at historical cost, non-monetary items. Here it is monetary items. Okay. Then we have recognition of exchange difference. An exchange difference results when there is a change in exchange rate between transaction date and the date of settlement of any monetary items arising from a foreign currency transaction. Exchange difference arising on settlement of monetary items or on reporting an enterprise monetary. So what is exchange difference? Exchange difference is nothing but the change in exchange rate between transaction date and the date of settlement of any monetary items. Change in exchange rate between transaction date and date of settlement of any monetary items arising from a foreign currency transaction. Exchange difference arising on the settlement of monetary items or on reporting on enterprise monetary items of the at the rate difference at the rate different from those at which they are initially recorded during the period or reported in previous financial settlements should be recognized as income. So recognition of exchange difference, very easy. 1,05,000 we had recorded on 31st March and 1,02,000 we are paying. So 3,000 rupees I made a profit. Okay. 1,05,000 I'm recording on 31st March and 1,07,000 I'm paying on for 5th April, then it will be 2,000 rupees loss. So same thing they are trying to tell you here. Recognition of exchange difference. Exchange difference can be in the form of profit and can be in the form of loss. Then we have translation of financial statements of foreign operations. So what you are required to do is you are supposed to classify your foreign operations and translate them into India, not only Indian, but in reporting currency. So classification of foreign operations. Foreign operations are classified as either integral financial operations or non-integral financial operations. Okay, integral or non-integral. The method used to translate financial statements of a foreign operation depends on the way in which it is financed and operates in relation to reporting enterprise. Integral foreign operations are foreign operations that is integral to the operations. Integral, internal part of the operations of reporting enterprise carries on its business as if it were an extension of the reporting enterprise operations. For example, such a foreign operation might only sell goods imported from reporting enterprise and remit the proceeds to the reporting enterprise. In such a case, a change in exchange rate between the reporting currency and the currency in the country of foreign operations has an almost immediate effect. So we have integral foreign operations. And what is integral foreign operations? Integral foreign operations are nothing but they are internal to the operations of reporting enterprise. Okay, they are internal. So for that they have taken an example such as foreign operations might only sell goods imported from reporting enterprise and remit the proceeds to reporting enterprise. They are only importing, and whatever they are importing, whatever is money they are received, that money they are passing it on to reporting enterprise. In such case, change in exchange rate between reporting currency and currency in the country of foreign operation has an almost immediate effect on the reporting enterprise cash flow from the operations. Therefore, the change in exchange rate affects the individual monetary items held by the foreign operations. Then we have non-integral foreign operations. Non-integral foreign operations accumulates cash and other monetary items, incurs expenses, generates income, and arranges borrowings, all substantially in its local currency. It may also enter into transactions in foreign currencies, including transactions in reporting currency. So we have non-integral. Non-integral means they are not related to basic operations. Here what you do, you accumulate your cash and other monetary items, expenses, everything related to your activities, related to your operations, okay, foreign operations, and they are not related to your main operations. Foreign operations are different, your main operations are different. Integral foreign operations, they are related, okay, they are related. Your foreign operations is sometimes your main operation. Factors indicating that a foreign operation is a non-integral foreign operations. So you have list of factors where you indicate that there are operations which are non-integral foreign operations. So while reporting enterprise may control the foreign operations, the activities of foreign operations are carried out with a significant degree of autonomy from those of reporting enterprise. Transactions with reporting enterprise are not a high proportion of foreign operations activities. Activities of the foreign operations are financed mainly from its own operations or local borrowings rather than from the reporting enterprises. So we have reporting enterprises may control foreign operations. We have transactions with the reporting enterprise. So they have given you points, they have given you a list of points, factors in which they are foreign operations, but you can relate them as non-integral foreign operations. A quick read, I'll take a pause, and then we'll go for translation of financial statements of an integral foreign operations. Then we have translation of financial statements of integral. So you need to translate your financial statements. As integral foreign operation is an extension to the reporting entity's business, there is a need to convert all the items of financial statements as if they are of reporting entity. So as integral foreign operations is an extension to the reporting entity's business, there is a need to convert all the items of financial statements as if they are of reporting entity. You need to convert. Internal foreign operations is an extension to the reporting entity's business. There is a need to convert all your financial statements into reporting entity currency. If you don't do that, you will not be able to upload your financial statements, you will not be able to present your financial statements. For converting financial statements of integral foreign operations, the rate should be taken as follows. For monetary items and contingent liabilities, closing rate. For profit and loss items, average rate. And for non-monetary items, they have given you a formula. So this way you determine your rate, conversion rate. Okay, a quick read. I'll take a pause, then we'll go for next. Then we have translation of financial statements of non-integral. Here it was integral foreign operations. Here we have non-integral. So in translating financial statements of non-integral foreign operations for incorporation in its financial statements, reporting enterprise should use the following procedure. Assets and liabilities, both monetary and non-monetary, of non-integral foreign operations should be translated at closing rate. Income and expense item of non-integral foreign operations should be translated at exchange rate. All resulting exchange differences should be accumulated in foreign currency translation reserve until the disposal. So they have given us how you can translate your asset liability, expense, income and expenses, and all resulting exchange difference. Disposal of non-integral foreign operations. An enterprise may dispose of its interest in a non-integral foreign operations through sales, liquidation. So how to go for disposal of non-integral foreign operations? So an enterprise may dispose of its interest in non-integral foreign operations through sales, liquidation, repayment of share capital, abandonment of all or any part of that operation. On the disposal of non-integral foreign operations, the cumulative amount of exchange difference which have been deferred and which relate to that operations should be recognized as income or expense. Change in classification of foreign operations. So when there is a change in classification of foreign operations, translation procedures applicable to the revised classification should be applied from the date of change in the classification. So we have disposal of non-integral foreign operations, change in classification of foreign operations. Then we have forward exchange contracts. An enterprise may enter into a forward exchange contract or another financial instrument that is in a substance a forward exchange contract which is not intended for trading or speculation purposes. So what is forward exchange contract? Let us try to understand in a small layman language. So I am a sweet shop owner. What I want is I want sugar, good amount of sugar. So I know from the month of August to Jan, I'll have a good demand of sweets. So because of the festive season. Yeah, so what I'll do is I will approach a farmer and I'll tell him that please, whatever happens, whether the price of the sugar is 40, 45, 46, 47, you sell me at 44. Okay, he'll book that price and today I'll do that. In the month of March, I'll do for the month of August. Okay, August to Jan. So this is nothing but forward contracts, forward exchange contracts. So same thing we do with the banks also. We approach banks and we book a exchange rate with them that whatever will be the exchange rate for 1 year, you charge me the conversion rate as 82 rupees or 70 rupees or 78 rupees. So even if the exchange rate fluctuates, I'm supposed to, whether it goes up, whether it goes down, I'm supposed to pay 78 rupees. Okay, so that is forward exchange contract. A quick read, then we'll go for disclosures. An enterprise should disclose the following. So whatever they are working on, they need to disclose. Enterprise cannot hide anything. So the amount of exchange difference included in the net profit or loss for the period should be disclosed. Net exchange difference is accumulated in foreign currency translation reserves as a separate component of shareholders' funds, and reconciliation of the amount of such exchange difference at the beginning and end of the period when the reporting currency is different from the currency of the country in which the enterprise is domiciled. The reason for using a different currency should be disclosed. When there is a change in classification of a significant foreign operations, an enterprise should be disclosed. The nature of change in classification, reason for the change, impact of change in classification on shareholders' fund, the impact on net profit. So all these things needs to be disclosed. Translation provision. On the first time application of this standard, if a foreign branch is classified as non-integral foreign operations in accordance with the requirement of the standard, the accounting treatment as prescribed in respect of change in classification of foreign operations should be applied. So we have transitional provisions. So what is transitional provisions? On the first time application of this standard, if a foreign branch is classified as a non-integral foreign operations, in accordance with the requirement of this standard, it is classified as non-integral foreign operations in accordance with requirement of this standard. The accounting treatment as prescribed in respect of change in classification of foreign operations should be applied. That is transitional provisions when you need to apply your foreign operations. And then you have comparative analysis, that is fine. A quick read, then we'll go for sum number 7. Here you have, during the financial year 21-22, Zeds Limited, an e-commerce firm, entered into a foreign currency transaction relating to fees for technical services paid to Lucas Limited, an Atlanta-based organization in USA. So see, in the year 21-22, what they are doing is they are paying to Atlanta-based organization in USA. The transaction was for $24,000, which was entered into on 7th December 21. The payment for the same was made on 20th May 22. In between, you have a closing 31st March 22. Given that exchange rates, so they have given you exchange rates also. You are required to ascertain the amount at which the transactions would get recognized in the books and calculate the amount of foreign exchange gain or loss to be recorded in financial statements for the year 21-22. So it is easy. You have $24,000. Okay, so as per AS11, a foreign currency transaction should be recorded on initial recognition in the reporting currency by applying to the foreign currency amount the exchange rate between reporting currency and foreign currency. So what you do is, whenever you are purchasing, that date, exchange date, you'll have to apply first. Then you'll have to closing date, exchange rate you'll have to take, and then later on payment. So same thing, we had taken one example, 1 lakh, 1 lakh 5 and 1 lakh 2000. Same thing they are doing here. And finally, they are suffering an exchange loss. Okay, a quick go through. I'll take a pause and then illustration 8. Okay, I'll do that. So illustration 7, let me go through illustration 8 also. Subhash Limited purchased a machine costing rupees 216 lakh on 1st April 2021, and the same was fully financed by foreign currency loan payable in 3 annual installments. Exchange rates were $1 for $1 rupees 67.50 and rupees 70.45 as on 1st April 21 and 31st March 22 respectively. First installment was paid on 31st March 22. The entire difference in foreign exchange has been capitalized. Advise how the exchange gain or loss should be accounted for by the company. So you have 21 lakh 60,000, 216 lakhs rupees. That is in rupees. No, 216 lakhs. Okay, 216 lakhs that you need to convert into. Yes, that you need to convert into dollars. So you are converting into dollars first. And what you did is 70.45 and 67.50 are your exchange rates. Okay, you need to add different dates, 1st April 21 and 31st March 22. So you need to take a difference to calculate exchange loss or profit. So obviously you are earning a loss. That loss you have to book. That. Yeah, so we have completed this chapter. Thank you.